If your investment company shuts down tomorrow, do you know exactly how to get your money back? Or are you just hoping everything will be fine? Most people chase returns, 15%, 20%, guaranteed profits, but almost nobody checks the one thing that actually matters. Who legally controls the money? Because after 10, 20, 30 years, return means nothing if access disappears. Today, I'm going to show you the criteria that protect serious capital. And if you ignore them, you're not investing, you are gambling. So if you're serious about building long-term wealth, subscribe to this channel. I publish practical investment education every single day. And if you want to go deeper into building a structured investment system, there is a free webinar linked in the description. It's completely free and it will help you think at a different level. I'm Ravi Gabes and welcome back to the Gabis Show, where we unlock the secrets of real wealth in the United States every single day. And today we're gonna deeper into something extremely important, the criteria for choosing an investment company, especially if you're investing for the long term, 10 years, 20 years, 30 years. When you invest for decades, one question becomes critical. Will you still be able to get your money back? Most people focus only on return. That's a mistake. We already discussed the access to your money. Without access, you should never invest. Now let's go even deeper. First criterion, time in the market. If you're investing for 20 or 30 years, it makes sense to choose a company that has already existed for a long period of time. You're trusting them with your capital for decades. Longevity matters. Second, your own brokerage account. This is extremely important. You should have your own brokerage account, not just transfer money directly to an investment company. Why? Because brokerage accounts are regulated. In the United States, brokers are overseen by regulatory institutions. There are protections in place. For example, SIPC protection covers up to certain limits, typically $500,000, including $250,000 in cash. That matters. When the account is yours, you can withdraw your money directly. When you give money to an investment company that pulls investor funds into one master account, you lose that direct control. If you want your money back in 20 years and they say, not now, what can you do? That's the risk. Third, the investment company should not also be your broker. Why? Because brokers make money on transactions. They earn commissions when you buy and sell. It's much easier for them to generate fees from trading activity than to patiently grow your capital and earn performance-based rewards. It's like asking a fox to guard the chickens. I've seen situations where brokerage companies overtraded client accounts just to generate commissions. That's very dangerous. Fourth, reputation. Search online, check history, talk to professionals, look at complaints, look at lawsuits. Long-term investing requires trust built over time. Fifth, jurisdiction and regulation. Where is the company registered? Who regulates it? In the United States, investment companies are overseen by the SEC. In Europe, there are strict regulatory frameworks. In other countries, different regulators exist. But if a company is registered only in an offshore jurisdiction, ask yourself, who protects your rights? Who enforces the law if something goes wrong? Offshore structures without clear oversight are a red flag. Sixth, minimum entry requirements. Serious institutional funds often have high minimum investments. Ray Dalio, for example, required very large capital commitments to enter his hedge fund. If an investment company accepts anyone with $100 and promises extraordinary returns, be careful. It's very suspicious. Seventh, Historical profitability, real verified performance. Be cautious with trading robots that show incredible results on historical data. Back testing is easy. Real markets are different. What works on a chart from the past 30 years doesn't always work in real time. Ask for verified, audited results, not just simulated performance. Eighth, transparency of holdings. The contents of portfolio should not be a commercial secret. Anyone can buy Tesla stock, anyone can buy bonds. The secret is not what you own, it's when and how you enter and exit positions. If a company refuses to disclose basic portfolio structure, that's a problem. If you follow these criteria, longevity, regulation, personal brokerage access, reputation, transparency, it becomes much harder to lose your money. Investing is not just about return, it's about structure, it's about protection, it's about access. And we will continue tomorrow with more layers of investment safety. If this kind of structured thinking helps you, subscribe to the channel right now. And if you want to build your own long-term capital strategy step by step, the free webinar is waiting for you in the description. See you tomorrow.